Matt, very good to see you. I'm so glad we have a chance to talk today because we are going to discuss three financial planning and investment opportunities in a down market, which we, of course, are in. Recently, the US stock market saw the biggest two-day wipeout in history, $6.6 trillion. In fact, the market has lost $11 trillion since inauguration day. Now, before we get into how to take advantage of this down market, I do want to talk through what we're seeing, which is something you and I have talked about before. The concentration risk in the market. 80% of the market's movement due to only 10 stocks. Now, to see that in a different way, this is a look at the S&P's 3-month performance, and the Max 7 alone have lost $2 trillion since the beginning of the year. I'm sorry. Yes, $2 trillion since the beginning of the year. Matt, what should we be keeping in mind when we see this much red on the board?
It's not just 10 stocks, it's all 10 stocks mainly in one sector, the tech sector. So the
Yeah.
big takeaway here is asset allocation and diversification. And when I talk about diversification, back in the day, the NASDAQ and the S&P had very little correlation, if any. Now there's a lot of overlap in all these different indexes, so it's
Right.
really hard to be diversified. And that's why we use things like those structured notes. They're outside the market. We can still get an 8, 9, 10% rate of return, depending on the note, but it's not tied to, the growth sector. It's not tied to Microsoft. So we want to be diversified. And of course, at the same time, we want to have investments that are outside of the market.
Yeah, you bring up a good point. You would think the S&P 500 is diversified with 500 stocks, but it really isn't. All right, so let's talk through how to take advantage of this down market. Number one, you say put your cash to work. It may feel better to kind of hide all your cash under your mattress right now, but that really does compromise your ability to build wealth.
It sure does. And we always want people to have the reserves. You need to have your 6 months reserves in your bank account. A lot of people have more than that. So, and I'm human too. Back when a couple Thursdays ago, when the market dropped 5% in one day, and then the next day, Friday, it dropped 5%. That Monday morning, I'm on the West Coast, so the market opens at 6 our time. I was here at 6, watching the market, listening to it, and it was interesting because something came out about tariffs first thing in the morning. Right, market dropped 5% again. Right. A few minutes later, tariffs were going away, right? Market went way into the green, same day. And then a few minutes later, hours, whatever it was, something about tariffs again. And in the end, the market ended fairly flat. But after about 2-3 days of that, I'm human too, and I hear the news and I hear what everyone else is saying. But I put my investment brain on and I said, what is really going on here? And after watching that, that was all about tariffs. It wasn't about the economy. It was about knee-jerk reaction to tariffs. So what did I do as an advisor? Did I hide more money and put it under my bed? No, I moved some money into my investment account. Thank you, Erin. And I went into an aggressive stock. There's only 2 people that did that, me and my nephew. Thank you for my nephew that called me up and I said, yeah, let's do it. But, and we're still ahead of where we were even after all that volatility. Don't get me wrong. We're not through it. The point, we're not market timers, but the point is, it's like that fear graph we used before. When your fear is the greatest, pull back and think, where's opportunity? You buy to the sound of war and you sell to the sound of trumpets. Here we are looking at this chart. I mean, we're down a little tiny blurb here, Aaron. Little tiny blurb. Look where we were even 2022. People are comparing it to 2008. That is so far ago. We're not even near what happened in 2022. We were down a whole year in 2022. Here we're down 3 months, right? And there's a lot of stuff going on with the tariffs. And I know it's not fun, but we will get through it. Use cash to take advantage of opportunity.
Right. And I want to just explain to everybody what we are looking at here. The top blue line is the S&P's performance. The middle blue line is bond. And that flat black line at the bottom is T-bills, which is essentially cash.
That's exactly right. Yeah. So
Okay.
the market wins over time, every time.
All right. Tip number 2, take advantage of all those stock losses and consider tax loss harvesting.
So when we talk about tax loss harvesting, we're talking about a non-qualified account. In other words, it's not an IRA, it's not a Roth IRA. It's just, you could call it a brokerage account, you can call it an individual account, a joint account, whatever you want to call it. It's like your bank account, but it has investments inside of it. If we hold on to those investments for more than 12 months, it's long-term capital gains, which is more than 15, which is for most people 15%. If it's dividends in the short term, that's your tax rate. Call it 24 or wherever you're at. But we can write off $3,000 a year And if you have more than $3,000 of losses this year, you can carry that forward. So it's a great time to do tax loss harvesting. In our non-qualified accounts, when we have a down market, I look at our cost basis and I try to wash it out to where there's as little gain as possible, because you're picking some of the losers and you're moving it over to try to buy something that you think is going to be better for the in the future economy with everything.
Mm-hmm. Mm-hmm. And then Les, can you explain? I'm
One
sorry, did I interrupt you?
No, not at all, Erin. One other thing there, though, is it's a great time to reallocate to tax-free investments in a non-qualified account.
Mm.
That way we don't have to worry about this tax loss harvesting.
Mm-hmm. And maybe that brings us to our last point. Explain why Roth conversions often make more sense in a negative market.
Because if I have 100 shares of something and the value dropped 50%, and I transfer those shares over to a Roth IRA, I'm paying tax on the 50% value, right? Not the 100% value that it was. I'm paying tax on whatever the value was when I move it over, right? But the benefit is I'm holding those same shares in the Roth IRA, and that ball will bounce. And now I'm getting much more growth in the Roth IRA. Great time to do that. I wouldn't wait till the end of the year. I would do that now.
Yeah, I'm so glad we had time to talk, because it does make me feel better realizing that there are opportunities and a silver lining to all this. But Matt, if somebody wants to talk through any of these strategies with you, what's the best way to reach you?
Give us a call at 425-256-3105. We'll schedule an appointment. We'll take care of you.
All right. Matt, thank you so much for your time today. I really appreciate it.
Thank you, Erin.